Following on from my previous video about investing in China, we want to find some great Chinese companies. Hopefully we can find one or two and then see if the market is offering us a great price. So let's start with one of the most well-known Chinese companies, Alibaba. If you're new, welcome to my channel. My videos are about investments that anyone in the world can make, not just Americans. And today I'm going to do a full analysis of Alibaba. Now I'm going to focus on the company in this video, but if you want more of an overview of China and investing in China, then my previous video is where you should start. Alibaba is a massive Chinese tech company, mostly known for its e-commerce businesses. So my first interaction with Alibaba was actually back in 2015 when I was starting my e-commerce business and I was looking to contact different manufacturers in China. And honestly, the platform wasn't that great to use, but it did work and I found many reputable manufacturers in China. They sent me samples and communicated with me on the platform to create the products that I wanted. But what I didn't realize was how massive Alibaba is on the consumer to consumer and the business to consumer side of their business. Alibaba is actually the world's largest retailer and e-commerce company. It is also one of the biggest artificial intelligence, venture capital, and investment companies in the world. Its assets include Alibaba.com, which is the largest business-to-business website in the world, 1688.com, which is the largest internal version of Alibaba.com, Taobao, which is the largest consumer-to-consumer website in the world. It's like the eBay of China. Tmall, which is the largest business-to-consumer website in the world. It's even bigger than Amazon. They have AliExpress, and a fun fact about AliExpress is they're actually the biggest website in other countries in the world, like Russia. Then there is Alipay, which is kind of like PayPal for the Alibaba platforms. It's run by a subsidiary called Ant Financial, and this is the largest fintech company in the entire world. The company is by far the dominant player in the Chinese market, with 55% of online sales going through an Alibaba platform. This is even better than Amazon's market share in the USA. Okay, let me explain how Alibaba has created an entire ecosystem inside the Chinese e-commerce market. Okay, so pretend you're sitting in your apartment in Beijing and you want to buy bathroom scales because you're trying not to be so lazy. You log into Taobao and you find good-looking digital bathroom scales sold from Nancy's Bathroom Scales based in Shanghai. You purchase these scales on Taobao using Alipay and there's no credit card needed. Nancy, from Nancy's Bathroom Scales, accepts the payment from Alipay. Now, Nancy doesn't manufacture these bathroom scales. She just sells them. And she bought 500 units by going to the website 1688.com, which is where Chinese retailers buy their products from wholesalers. Nancy also used Alipay to purchase these 500 units. The wholesaler buys 2,000 units in bulk from manufacturers through the Tmall website, also paid with Alipay. The manufacturers put their products on Tmall for wholesalers to buy. Now, Nancy doesn't only sell to individuals in China like you in Beijing. She also lists her bathroom scales on AliExpress, which sells to customers outside of China. So now your father in Australia can also order the same bathroom scales as you from Nancy through AliExpress and also pay through Alipay. Now, Nancy wants to expand into kitchen scales, but doesn't have enough money at the moment. So Nancy uses Ant Financial to get her financing to buy the new inventory. So all of the buying, selling, payments, and financing is all done through the one company. Alibaba has also recently been expanding into a shipping company, a messaging app, movie studios, and many more. They also have been aggressively buying up strategic companies like Lazada, which is the biggest e-commerce company in Singapore. So Alibaba has most of the e-commerce ecosystem inside of China. So as China grows and people in China get more disposable income, well, Alibaba is going to grow as well. Of course, Alibaba does receive its fair share of criticism, but what big company doesn't? The biggest criticism is that yes, some suppliers on their platforms are selling fake branded products. They have been sued by big designer brands throughout the world for selling these counterfeits. But it definitely has been addressed by the company and is something the company is working to fix. And these issues haven't reduced their market share in China. As you can see, Alibaba's popularity is growing every quarter. This graph is the active consumer base in millions. This is great to see. But like any investment, we want to make sure the company is going to be going strong in 20 years' time. And in my opinion, I strongly think they will be for the following reasons. Because they have such a strong ecosystem, their competitive advantage is really high. It will take someone like Amazon to challenge them in the Chinese marketplace, and it hasn't shown any signs of success in China yet. Alibaba have a range of different revenue sources, from financing to payment processing to advertising. They remind me of a cross between a PayPal, an Amazon, and an eBay. The Chinese market is huge, and as wages rise over the years and China becomes wealthier, they will want to buy more things. And number 4, they have shown that they are looking into the future by acquiring companies in supporting markets and neighboring countries. Look, I don't see many issues with Alibaba, and I'm actually really impressed so far. But if I'm impressed, I bet thousands of other investors are impressed as well. So we're going to have to go through their financials to make sure they're not too overhyped. Now, there are three key areas to the health of any business. Do they have too much debt? Are they growing? And are they well managed? Now, we want to see the company pass all three of these areas, but unfortunately, it's a bit more of an art than it is a science. But I have developed some criteria that we can use. And I developed my criteria by studying the legendary investors Benjamin Graham, Warren Buffett, and Bill Ackman. So sit back and don't worry about the terminology, just get a bit of a feel for what's going on. So first we want to see whether they can handle their debt. It is really important to look at the company's debt because if the business was to completely stop for some unknown reason, like the government made some crazy decision or there was some sort of trade war going on, well, with low debt, they're going to be completely fine. So to see if the business can handle its debt, I went through the debt to equity ratio and current ratio of the business. And for Alibaba, as you can see, since 2013, when they were gearing up to grow, since then, debt to equity has been very manageable. The current ratio is actually just a little lower than I would like. Normally, I'd like to see around about a 1.5 or higher, but it's quite close, so we will give it a pass, but it's not perfect. Next, we're going to see if they're growing, and we obviously want to make sure the company is growing, right? But 1 or 2 years isn't really going to cut it. We want to see long, stable growth over quite a good period of time. So to check for consistent growth, I look at the book value per share, the earnings per share, and the operating cash. And these are nearly flawless growth numbers here from Alibaba. If anything, it might be growing too fast and maybe it's unlikely to keep up this trajectory. So that is my only concern. I don't know whether they can grow at that speed forever, but it's definitely a tick for growth. And let's move on and to see whether they're well managed. Is the company well managed? Now, we can't just go and have a meeting with the management team and sit in and see what they're talking about, but there are some telltale signs inside the financials that will tell us whether the management are making some good decisions. So I need to check for cash deployed into investing activities, return on equity, free cash flow, the cash on hand, and if they've got a dividend. Alibaba are spending most of their operating cash on investing, which is typical of a growth company backing themselves to get bigger and bigger. This also explains why there is no dividend. They are growing and want the money for growth. Here we can see the return on equity, and it's solid above 10, so I'm happy with that. Their cash is impressive. Alibaba are growing their cash reserves so that they can deploy the money into new opportunities and expansion plans. They will be able to take on the future in a good position. So does Alibaba look like a good company to invest in? So let's now dive into my intrinsic value calculator and find the price that we would like to buy it at. So you can get your own copy of this exact same intrinsic value calculator in the description below. And I've done a tutorial video on exactly how to use this, which is about 5 or 6 episodes back. So go back and watch that for a demonstration. Okay, let's now look at Alibaba. So I've used 15% as my growth rate for years 1 to 5, and the analysts think it's going to be 18%. So I just wanted to be a bit more conservative than that. Then I've used 14% for my growth rate from years 6 to 10. My discount rate is 20% now. I want 15%, but then a margin of safety. So that's why it's 20%. The multiple I could sell it for is 15. Now, this is a very high quality company, so we're going to give it a 15. So it's like Google. And the operating cash flow minus maintenance capex. Now, if you want a demonstration on how to find this number, please watch the tutorial, but it's 25 billion, and I've had to keep this in millions. And the shares outstanding is 2.6 billion. Again, I had to keep it in millions. So the first price that I'd like to buy it at is $144.36. So about $145. Under that would be great. Now, I went and done it for a second buy point as well. And as you can see, I've adjusted some of the calculations. So it's a little bit more conservative. I've used 14, 12, bigger margin of safety. And the second buy price would be $116. So that would be where I'd be buying more of Alibaba if it got to this price. Now, I've also done a very aggressive buy point. So this is very unlikely to happen, but if it ever did happen, I'd really want to be buying aggressively because the share price is not reflective of the value of the company, like not even close. So I've got even more conservative growth rates. I've got a bigger margin of safety. Again, 30% is actually really big. And the price is $63. Now, let's go check what it is. The current price is right now. And I've just gone to Yahoo Finance to check the current price of Alibaba. And as you can see, it's about $206. So that's far away from where I want to buy it at. Well, Alibaba is a strong company, but the share price is just too high at the moment. But I would happily be an investor if the price ever got to $145. So to summarize everything, Alibaba is a great company and performing really well. The current price is just too high and we'd need to see a 25% fall in the market price, which is totally possible. I'm definitely adding Alibaba to the list of my companies that I'm going to be watching closely. They have a strong e-commerce ecosystem in China. China is a huge market. They are investing in the future and their finances are solid. Now, Chinese companies don't have the most trustworthy reputation regarding financial reporting. So I'm not going to go out and pay any more than what I think fair value is with a good margin of safety. But I will be pouncing if the company's financials are still solid when the market price falls down to $145. Obviously, I want to go check the financials just to make sure that nothing dramatic has happened to make that price go down to $145. Until then, I'll keep looking for investment opportunities and hopefully I can add one or two more Chinese companies to my watch list. Please hit subscribe if you enjoyed my analysis and I will see you in the next video.